Hello, and welcome to another edition of the Up Your Assets podcast. I'm your host, Ray Ferraro, CFP, founder and executive chair of Provise Management Group. One of the most important assets that you can obtain is life insurance. But life insurance, while sounding like a simple concept, you die and your beneficiaries are paid the proceeds, it is really quite complicated. Early in life, especially after one is married and or the first child is born, it's needed to replace a breadwinner's income for the family. As life moves along, you may find that you have some debts, like a mortgage, business loan, or a car. Life insurance can be used to pay down or pay off these loans. Finally, if you're fortunate enough to have a taxable estate, it can be paid to use for estate and inheritance taxes. Insurance companies offer a variety of policies. The least complicated is called term insurance. You buy it for a specific number of years, maybe 10, 20, or more years. Term insurance is the least expensive form of life insurance and is often the best way for people to buy the most coverage at the lowest price. When the term is over, the policy ends, and generally, there is no further value. Another form of life insurance is known as whole life or cash value life insurance. In this type of life insurance, in addition to the death benefit, there is a savings element. Thus, the premiums are much higher per dollar of coverage. Over time, the savings element increases, which helps to make the policy last until the policyholder passes away and thus is permanent rather than for a specific term. It comes in many different forms, however. Whole life provides a guaranteed savings plan, which is known from the outset. Universal life provides certain guarantees, but depending on interest rates and other factors, it could be higher than the guaranteed amount. Then there's variable life insurance, where there is no guarantee to the amount of cash value because the savings account is invested into sub-accounts made up of stocks, bonds, and other investment vehicles, all of which comes with the potential for even greater returns. The insurance companies create the cost of insurance based on one's age, health, and lifestyle. The older you are, the more health issues that you have, whether you smoke or perhaps scuba dive, parachute out of planes, have a dangerous job, etc., the more expensive the policy. The life insurance business is regulated at the state level, so different rules exist in each state, but many of the regulatory bodies have similar guidelines. To help us unpack all of this is my good friend Barry Flagg, CFP, CLU, HFC. He is the president and founder of Veralytic, which is based in Tampa, Florida. He approaches life insurance very differently than most people and has created software which brings clarity to the underlying costs of an insurance policy and does so with a fiduciary standard of care. He is recognized as an expert, having been quoted in many financial outlets, including USA Today and Forbes. Barry, welcome to Up Your Assets.
Terrific to be here with you, Ray.
Barry, please take a few moments to tell us how you got into the life insurance business, and more particularly, how you came to approach life insurance at a fiduciary standard of care, putting the client's interests ahead of your own.
So I actually started in the fiduciary business first. I was a junior analyst in a full-service financial planning firm. My father started back in the 60s. He created a multidisciplinary practice even before that was a word. Wouldn't let me work for him, so luck of the draw, I went to go work for his partner that ran the pension investment advisory department. And my job was to look at the pension and profit sharing plan statements that they would bring back from meetings and look the funds up in some source of independent research, which many of you may know of. Morningstar was what we used. So I'd look the funds up in Morningstar, and I'd say, does the current fund line up on this statement? Is it got high cost or low cost? Does it have good performance? Does it have bad performance? And if there's a statement that had high costs or inferior performance, my job was also to go look up other funds, better rated funds, give those to the partner to go back out to the meeting and talk to the client about it.
Hmm.
And that's how I cut my teeth in the financial services business. Some years later, I actually did that while I was still in college. I graduated from college, and to broaden my experience and expand my resume, I went to go work for a life insurance agency. Uh, and as I know, those two experiences could not have been more different. Uh,
Isn't that the truth?
they say, well, there's nothing like Morningstar for life insurance. So what we do is we take one of these hypothetical projections that never comes true, and we compare it to another hypothetical projection that never comes true, and we call that due diligence. And as you can see, was scratching my head a little bit for a while, and eventually came to the conclusion that somebody was going to invent. They said there was no such thing as Morningstar for life insurance. I said somebody was going to invent it. And so I filed for the first of a number of patents, was awarded the first of a number of patents in accelerated status, which means that I got a patent in 9 months, while Amazon was taking 4 years to get a patent at that time. That's not any claim that I'm any smarter than anybody else. It's just that when I was told that at 21 years old, there's no such thing as Morningstar for life insurance, it was true. There was nothing like it. So there was no comparable art. So they issued it in accelerated status.
Well, you got started really young, and you do have one
I did.
claim to fame that I'm particularly pleased to share with everybody, having been on the CFP board of directors and the chair in 2014, and that is at the time you were the youngest person to ever receive their CFP designation, if I'm remembering correctly.
You are, at the time, some younger whippersnappers have since beat me out. But that's really not, I really don't deserve a lot of credit for that. My father, as I mentioned, had built a multidisciplinary practice before that was even a word. He was active in the financial planning movement from the very early days when it was located in Colorado instead of Washington. And so this apple just didn't fall too far from that tree. And I got immersed in, and he said, look, son, if you want to if you're serious about the financial services business as a profession, not just a way to make money, but as a profession, the way doctors approach their profession, the way accountants approach their profession, then you need to be credentialed. You need to have something to sell other than the product, and that would be a service based on knowledge. So that seemed to make sense to me, and I went and got my CFP. And at the time, I was the youngest in the history of the college. Yes.
Oh, well, it's a great story.
Thanks.
Well, most of us have, at one time or another, worked with an agent, broker, or provider of insurance products for years. It's said that life insurance is sold, not bought. Why should we care about the differences between the fiduciary principles and/or the CFP practice standards versus the old regulatory regime governing life insurance products and recommendations?
So the old regulatory regime is not necessarily old. It's still present in 49 states and whatever the territories are. The insurance industry, the vested interests in the insurance industry, are actively fighting against the rules that fiduciaries follow, or the principles that CFP practice standards are based on, which are categorically, I refer them categorically as clients' best interest rules. The insurance industry is actively fighting against it. You can look up the lawsuits against the New York Department of Financial Services. You can read about the lobbying efforts against the California Senate. They are actively fighting to preserve the current. Someday it will be the old regulatory regime, but right now it's still the current regulatory regime in most states. And that regulatory regime allows agents, brokers, and insurers to quote, these illustrations. By the way, this doesn't apply to term insurance. Term insurance, as you said, is simple. There's a premium, it's guaranteed. There's a death benefit, it's guaranteed for a specific period of time. But for everything else, universal life, variable life, whole life, the insurance company is allowed to quote a premium or quote a premium duration that appears to offer low costs while they're actually charging high costs. without disclosing the risks of them coming back later for more money to cover those high costs. In any other situation, in any other industry, that would be called bait and switch. In any other segment of the financial services business, that would be called fraud. So the current regulatory regime is allowed to make it look like costs are low while they're actually charging high cost, and then come back later for other costs after you're already on the hook. So it is paramount that consumers are dealing with a fiduciary or a CFP, or you have to know the person really well and know that they're following best interest practices. Because if you're not dealing with a CFP and you're not dealing with a fiduciary, and you don't know them really well, then they're likely to be following this regulatory regime that is the law of the land in 49 of the 50 states, where you can be charged high costs, even though this illustration you get looks very attractive.
So important to point out that for the past half dozen years, actually a little bit longer than that now, a CFP professional must act at a fiduciary standard of care when providing financial advice, and that includes advice on life insurance, as you pointed out. Barry, let's take a moment and kind of unpack some of that a little bit more. Now, in a whole life policy, the traditional policy that existed when you and I started in the business, everything's guaranteed, and what you see is what you get. And it's really hard for the insurance companies to change the rules once you're in. But as they develop the universal life concept and the variable life concept, you're right. Things are not as guaranteed as they were in the old whole life products. They can raise the internal cost of the insurance. They can reduce interest rates. They can add and subtract different investment options if it's variable life. So all of that can change. And so people need to be aware of it. And it's great that you pointed out that unfortunately most agents don't spend any time talking about those kinds of changes.
Yeah, I would modify a little bit of what you said about whole life. So back in the day, before there were computers, when you and I were first starting out, when they had, or when my dad was starting out, when they had rate books, right? And everything was guaranteed with whole life back in the day. But with the advent of universal life in the 1980s, whole life was at a marketplace disadvantage. The whole life premiums were calculated by actuaries in dark rooms with visors and pocket protectors, and it was highly regulated. Universal life premiums are calculated by the agent using a computer system in his office, oftentimes.
Mm-hmm.
And it doesn't take a rocket scientist to know that if you get two pieces of paper that are these quotes for insurance, and one quote says the premium is whatever $10,000, and another quote says the premium is $5,000, and they otherwise appear the same. They're not, but they otherwise appear the same. The consumer's going to pick the $5,000 premium. No one willingly pays more for car insurance, home insurance, or life insurance.
Absolutely.
So the whole life providers were at a competitive disadvantage. And so they made some changes to the products and the illustration systems. And so the whole life premium, the whole life policy is guaranteed that you don't pay more than a certain amount per year. But the illustrations will be like, well, you only have to pay the premium for 10 years or 5 years or 15 years or whatever the number is. And that payment duration, depending upon the way that is calculated, is not guaranteed. And it can go from 5 to 20 in some cases. They also introduced a mechanism to compete with those universal life premiums by blending in kind of a term insurance element and a whole life element, and there the premium may or may not be guaranteed at all. So the policy that is, and this, by the way, this applies to all financial instruments. The financial instrument that is in your best interest as a client, in the client's best interest, is the policy that has the lowest cost relative to benefits for the peer group, the rate of return that's reasonable to expect. And if you're in whole life, you got some guarantees, so that would be a low rate of return. And the risk that's appropriate to the client's risk tolerance. So if they had a conservative risk capacity or risk tolerance, they'd want to be in something like a whole life policy. If they had a more risk-taking risk profile or capacity, then they could allocate cash values to kind of like your 401k, a family of mutual funds in a product that's called variable. But looking at the illustrations and thinking that a whole life illustration is guaranteed would be a mistake without further investigation. And looking at a universal life illustration and thinking that the premium is lower and therefore better than the whole life would also be a mistake, because ultimately both premiums that have to be paid have to cover the costs. So costs have to be justified or competitive for either product to work.
Got it. Well, I believe that there are 3 reasons to own life insurance: to replace income, pay off debts, as we talked about earlier, or to help cover the costs of estate and inheritance taxes. I've mostly recommended term insurance products to our clients, as I'm not big on life insurance as an accumulation vehicle, unless the need for insurance is a permanent one. Given that the estate tax exemption is now $15 million for a single individual and $30 million per couple, I now see even less need for permanent type products. Am I wrong with that? When do I need to care about such things?
So you're not, I don't think you're wrong. Term insurance, as you said earlier, term insurance is always less expensive up to somebody's life expectancy. And it's just basic math. The insurance company prices term insurance where they know they're not going to pay half the claims. Think about it. They're not going to have to pay it's kind of like car insurance, right? They know they're not going to have to pay on every single policy. And if they don't have to pay on every single policy, then they don't have to collect premiums to pay for every single policy. Term insurance is always, always, always cheaper up to life expectancy. But if you have a need that's longer than life expectancy, then permanent insurance is almost always cheaper over your lifetime. And, estate taxes is one reason. If you have a business and you want to pass it on to the next generation, even if there's not estate taxes, there can be reasons to have life insurance, either to help that with the transition of that business to the next generation, or to balance the estate, or special needs trust. So there are still a good many reasons for permanent life insurance. But it has to be a permanent need. It is not, with some rare exceptions, it's not an accumulation vehicle unless you are in a very high tax bracket with asset allocations that generate a lot of ordinary income and therefore a lot of ordinary income tax. However, for a long time, the state tax exemption has been a lot lower. And so while anybody thinking about insurance, new insurance, term insurance may be more often appropriate today than it was in years past. I can't tell you how many people have a whole life policy stuck in their drawer or a universal life policy stuck in their drawer, and they don't think about it anymore.
Yeah.
And I can't tell you how many planners I talk to who, because it's insurance, because it's been outside of the fiduciary world, it's kind of off balance sheet, it's outside their financial plan, and there is an awful lot of insurance that has never, where the costs have never been analyzed, ever. And half of them, if there's a pool of policies where costs have never been analyzed, the law of averages says half of the people in that pool are being overcharged. In our experience, it's about 40% have an opportunity for a cost improvement if you've never looked at your costs. Can't say who's in the 40% they're going to get that have a chance for cost savings and who aren't. But if you have a policy as a consumer, or if you're an advisor and have clients with policies, there are cost savings available about 40% of the time, and new investable assets, because these policies oftentimes have high cash values and the high cash values are in there to cover the high costs. Well, if you lower the costs, you can kick the cash values out and reinvest it in some other account.
Sure. Well, life insurance is a subset, in our estimation, of financial planning, just like investment management, retirement planning, risk management. All of these are subsets of an overall financial plan. But life insurance has become so complicated over the years, and that's why we turn to an expert like yourself to help us. Why is it that life insurance seems so different? And what do I need to know to properly advise clients without becoming an expert like yourself?
So uh, I want to modify again something there. Life insurance is actually not as complicated as it is made to seem. Life insurance, like any financial instrument, life insurance has costs. They have some more costs because there's cost of insurance charges that are not in a mutual fund, right? But there are
Sure.
costs. There are performance expectations built into these quotes. When you do a retirement plan, there is I expect to get 7% on my retirement account so I can retire someday, or so. Same thing. There are performance expectations inside these permanent policies, and then there's risk considerations, risks of underperformance, risks of the insurance company um, being good on their promise to pay, et cetera. Uh, what makes it complicated is not really that it's complicated, it's obfuscated. The insurance industry, the current regulatory regime that I referred to before, they are adamant against disclosing costs. Adamant against giving the consumer the information they actually need to discern between a product with low costs and therefore in their best interest versus a product with high costs. So it's not so much that it's complicated, it's obfuscated. So to make it more understand, and nobody can understand anything, not just life insurance. If I told you, here's an equation, Ray, it's got 4 variables in it, but I'm only going to give you one of them. Can you solve the equation? Right? If you were
Absolutely
you
not.
right? If I withhold information, it seems complicated. So the inverse or the converse of that is you have to have the information. So ask for what are commonly referred to as policy accounting pages, cost disclosure pages, detailed expense pages. Every insurance company calls it something different, but just generically, you have to get those cost disclosure pages. And if you have to ask too many times, you might start asking somebody else, because the people who are fiduciary oriented, CFPs, fiduciaries, that's their world.
Mhm.
Every aspect of the financial plan is, are costs justified? Is performance reasonable to expect? Are the risks appropriate to the client's risk tolerance or risk capacity? Um, so you don't have to be an expert, but you have to get the information necessary to actually understand whether it's a product that's in your best interest or not.
Well, it seems like every agent, broker, or provider of insurance products offers some kind of a policy review, which seems sort of like a conflict of interest to me. Where can one get a conflict free piece of information to properly advise clients and for clients to find out what's going on with their existing policies and to consider alternatives?
So I mean, there are consultants. Most people. I mean, if you're a really high net worth individual paying somebody $500 an hour for 10 or 20 hours to do something like that, I mean, that's one way. Some of those consultants are customers of Veralytic because it makes their job easier. It's easier to look something up. Again, another analogy to the investment business. If somebody has to read through 24 prospectuses that are each 100 pages long, that's a more time-consuming job than looking something up in Morningstar. And so Veralytic provides consultants and financial advisors the same ease of access of information for life insurance products that financial advisors have long had for mutual funds. So you could hire a consultant. You could work with somebody who is one of our customers, or you could get a direct report from us, and it would give you in one report. A la carte. Most of our customers are financial advisors who pay a monthly fee. I would urge most consumers to seek out one of those financial advisors where they're not doing the policy review themselves that is rife with conflicts. They are getting an independent, conflict-free Veralytic report that's you mentioned featured in Forbes, USA Today, the Wall Street Journal. It's been reviewed by the chief regulatory body of the financial services industry. That's not an endorsement, but it has been reviewed for compliance with their rules for fair and adequate disclosure and clients' best interest considerations. Um, so you can hire a consultant. You can work with one of our customers, one of our Veralytical, what we call Veralytical advisors, kind of a play on our word, and that they're analytical and they're independent, and they're actually advisors, not salespeople. Or you can get a report directly from Veralytic.
Well, as we've chatted about several times, most people don't want to become life insurance experts. So you kind of talked a little bit about getting best execution placement of product recommendations that are independently verified. Let's tell us a little bit more about the Veralytic process itself, so that people understand what it is that you really do.
Sure. So it's a database. It's the largest database available to financial advisors and consumers of the things that we've talked about during our call here, during the podcast here. It is got all the costs for or benchmarks for costs for every age between 18 and 85. It's got all the expenses, the administration expenses, the premium loads, or benchmarks for all the expenses, uh, administration expenses, premium loads, wrap account fees, um, and all it does is if you're or when you're considering a policy or you have a policy, you submit that policy to the database, and then the database simply compares what you're actually being charged in cost of insurance charges and admin fees and premium loads and wrap fees to
Mhm.
everything else in the database. It's all algorithmic. It's all mathematical. It's not somebody's opinion. There are judgmental techniques that are fully disclosed in the user guide that, again, have been reviewed by the chief regulatory body of the financial services industry. Certain financial professionals disagree with the judgmental techniques, but they're fully disclosed so they can say where they differ in their advice to their clients. All above board. It's not mine's better versus yours better for reasons we're never going to talk about. It's all disclosed. Everybody has access to all the information.
So, as an advisor, I can use your services, as you said, on a monthly subscription basis. But what about the public? How is that priced? If they want to get an analysis on their existing policies.
It's $500 per report. So it's more expensive than a Carfax. And for that reason, and for actually two reasons, I would encourage consumers to we can connect you with a Veralytical advisor. The Veralytical advisors, again, they're not going to give you their opinion. They're going to give you a report that they have no control over. It's generated by Veralytic. It's the same in Portland, Maine as Portland, Oregon. It's conflict free. They are paying us a fee so that the consumer doesn't have to pay a fee. And the second reason why, just in my experience and in practice, it's usually optimal unless you're working with a consultant and just paying for the reports yourself. If the report comes back 5-star, you're good. You just put it in your drawer. If the report comes back 2-star, there are going to be some things that need to be done um, to make changes to that policy so that it is in the consumer's best interest. And those changes, more often than not, will involve somebody who has licenses that the consumer doesn't have, and oftentimes licenses that an investment advisor doesn't have. So if you're working with a Veralytical advisor, you're working with somebody who is not making up their own policy review where they can do what my dad used to say: the last guy with the pencil wins rules. You know, if I get a higher commission on this one over here, I'm gonna make sure that one looks better in the policy review, or or if it qualifies me for a trip with a particular insurance company, then that one is, lo and behold, that one's going to come out best in the policy review. With Veralytic, it's all algorithmic. It's all math driven. Veralytic doesn't go on conventions. Veralytic doesn't get paid commissions. We get paid a flat fee, either $500 per report or a monthly fee from the advisor, or a enterprise fee from the enterprise. And the report is the same in Portland, Maine as Portland, Oregon. And if you work with a Veralytical advisor, then if there's something that needs to be done that's almost always going to be above the knowledge base of the consumer, then you have somebody that you can work with, and they've already kind of demonstrated that they're interested in reconciling conflicts in the consumer's best interest because they're using Veralytic rather than doing the review themselves.
Well, Barry, wow, what a great way to spend some time with you to learn more about Veralytic and the services that you provide, and kind of, as we talked about in the beginning, unpacking all of that stuff that makes up life insurance. So thanks so much for being with us today. Best of luck with the things that you've been working on your life over, and congratulations on your great success. Now, to all of you out there, go out and up your assets.
This has been another edition of the Up Your Assets podcast, hosted by Ray Ferrara, CFP founder and executive chair of Provise Management Group, LLC. The preceding presentation was for general information purposes only and not personalized advice. Seek out a professional before making any financial decisions. Additionally, no guests pay to be on the show or are paid to be on the show. The opinions expressed are their own and not the host's or the show.